Please welcome the panel on Wealth Management, Merging Public and Private Market Strategies, moderated by the founder, CEO, and chairman of CASE, Matt Brown.
Whoa. Wow. There's some really sinky chairs here. Okay. Welcome to the future of wealth management, public and private convergence. My name is Matt Brown. I'm the CEO and founder of CASE. When I tell you that this is really a moment in time that we're experiencing in the industry, enormous opportunity, but also really a time to be careful as we navigate through this. Today we're discussing the convergence of traditional assets, stocks, bonds, ETFs, and mutual funds with alternative investments. So private equity, private credit, real assets, and most importantly, the impact of this convergence will have across the wealth management industry. For background, wealth management in the US, the total number of dollars that financial advisors oversee is approximately $45 trillion, and over the next 10 years, estimated to be somewhere near $70 trillion. Average allocation rates to alternative investments in this channel are somewhere hovering between 1%, 2%, or 3%, depending how you want to look at it. Now, if you compare that with institutional allocations to alternative investments, which are around 25 to 50% of a portfolio, that means that there's a lot of room to grow. Now, the primary reason why wealth management has such low allocations to alternatives are often found in the fact that there's a lack of access to products and, frankly, a lack of understanding or education around alternative investments. But with technology, with product innovation, it's all changing. And that's really going to be a very big theme for today's conversation. One main question that I think we all have to get at and understand is that with over 85% of US companies with $100 million in revenue or more are private. How can a financial advisor or an individual investor participate in the growth of the US economy when so many companies are remaining private for so much longer? At the same time, alternative asset managers are looking to grow their business. And they're looking at wealth management as a channel to be able to attract new investors. And when you look at the low allocation rates of alts in wealth, there's a tremendous amount of room to grow. It could be upwards of $10 trillion over the next decade coming out of wealth management and investing in alternative investment strategies. Therefore, another main question: could these two powerful trends, the demand from advisors wanting alternative investments and the demand of alternative asset managers wanting to grow their business with wealth, could they be the underpinnings that is actually driving the convergence of traditional and alternatives? This panel, of course, will answer that and many more questions. Let me introduce our panelists. We have just a great group of industry leaders. My order does not match this order, but we have Jose Minaya, Global Head of Investments at BNY, Andy Sigg, Head of Wealth at Citi, Mina Flynn, Co-Head Global Private Wealth at Goldman Sachs, Joan Solitar, Global Head of Blackstone Private Wealth, and Rob Havert, Founder and Managing Partner of Motive Partners. Welcome. Thank you. Before we jump right in, I just know so many of you have had a lot going on the last month or so with the economy, with the position of the tariffs and so forth. And I know all of you touch so many financial advisors, tens of thousands, who work with millions of individual clients. My question for you is, what are you hearing from them, and how are you advising them during this window of time? Mina, maybe I could start with you.
Sure. Yeah, no, absolutely. I think the one thing that we continue to reiterate to our clients and our advisors is the importance of portfolio construction. And if you do that work up front and you do it on an ongoing basis, you should be really well set in an environment like this to actually not just stay put, but potentially take advantage of opportunities and the volatility. And so we do remind our clients why we have our portfolio construction the way it is, that there are going to be drawdowns. The average recession has a peak to trough drawdown of about 25%, so you give them some historical context. And then also really think about, again, what are the opportunities to be able to take advantage of in this market by using volatility as your friend and using, for example, some alternative investments.
Rob, anything to add?
I'm actually going to go last, maybe, because I'm the...
All right, Joan, why don't you please weigh in?
Because I'm the plumber here. I don't look like that,
sure.
but I'm a plumber.
No, one I would say is that the discussion we're having today is not that different from what we've been advising our clients all along, right? Which I keep using this term of, everyone started understanding the academic exercise when you talk to people around, hey, volatility is coming, inflation may be coming, solutions really matter, like having a portfolio that's driven towards your outcomes matters. But, you had the better half of almost 2 decades of markets just rising and being able to invest in kind of like things at low cost. And now when you find yourself in volatility, what you're hearing from clients is like that realization of, even with markets kind of bouncing back, it's like they've felt what volatility seems like. I keep saying that where we are today, especially in the US, I think we've hit an all-time high in terms of uncertainty, right? So not only have you seen the volatility in the market, clients are looking ahead going, hey, how rocky is this going to get? How concerned should I be? And it comes back to, hey, this is the same advice. This is why we exist. It's the advice we've been given all along. It hasn't changed. And again, it comes back to what are the fundamentals? What are the real solutions you're trying to build to? But the challenge is when you're thinking, offering alternatives, these different asset classes. In that moment, it's not like it's easy to get that exposure. So there's also that realization with your clients in that conversation of saying, well, I don't have a switch to necessarily just hit like that says everything is kind of solved for the future. So again, it goes back to the fact that these things have kind of longer J curves.
Andy?
Well, Matt, thank you. It's a great question to start with. I had the benefit of the perspective on Liberation Day of being in Hangzhou, China. And so I can give you some similarities between conversations in China and conversations in the U.S. And in summary, I think clients have the same questions. Hey, what's this mean for the markets and the macroeconomy? What's it mean for my business? What's it mean for my family? And what they want to hear from their advisor really boils down to 2 things. Can you give me some context on this? Help me understand. And then, let me know, am I going to be okay? And I start there because when we talk about private markets, public markets, all the technical aspects of this conversation, for clients it really boils down to, are we building durable portfolios? Are they appropriately diversified? Am I going to be able to achieve the results that let me deliver for the things that matter to me? And so, thanks for starting there, because I do think putting in clients'
And
eyes.
how has that been received?
Oh, I think in this environment, you cannot underestimate the power of proactivity with clients, just having a conversation. And then what's important, and you see here on the stage, you've got people who have been in this business across market cycles. And in many cases, clients, they haven't been across market cycles with the same stakes they have right now at this market cycle, because they may have had a liquidity event 2 years ago. Much more of their wealth is tied up in investable assets today rather than their business. So they're experiencing the news very differently than they may have, the last time there was a disruption in the markets. And so, that is, again, I don't mean to simplify, but engagement, context, reassurance, help people say, hey, this may be a shock in the moment, but so many of the secular forces are alive and well, talent, innovation, free markets. Don't lose hope. Don't do something rash.
Joan, you're taking this from a slightly different perspective as an asset management firm. You've successfully built the biggest wealth division in an alternative asset management organization, a leader in the space. How are your conversations with your clients in the wealth area as an asset management firm?
Yeah, first, also pleased to be here. So I would say you can't ignore what's happening in the public markets, even if it's not directly impacting your day-to-day. But you have to acknowledge that the advisor is mostly dealing with public market volatility and may not be quite as interested in talking about what's happening in the privates because it wasn't, there was no sense of urgency, if you will. We've been, I'd say, really pleased with the resiliency of flows through this period. And I think it's not dissimilar to other periods of turbulence where there's just recognition that I have publics going like this, and I could use some additional diversification. And at the end of the day, people are investing because they want income or they want appreciation and growth, and you can get that in a lot of ways. But every time we've gone through a period of turbulence, it's actually benefited us on the other side. So I think it's not unreasonable to assume until we have greater clarity on tariffs, on direction of the economy, that there are going to be some folks who don't want to make a commitment to a much longer term, less liquid asset until they know. And I don't know if that's 30 days or 60 days, but I think the value proposition is still very much there. And if you just look at activity levels, so engagement of advisors, the activity levels are up here.
As a platform, we have hundreds of different asset management firms, and we have the benefit of being neutral and seeing all the flows. And I can tell you, just the month of April alone, the activity was off the charts, flows stronger than ever. So at least the message has been getting out to the advisor community that, in times of stress, not to sit on the hands, but actually this could be an opportunity in a moment to increase allocation.
But I think we have a long way to go. I mean, I'm very different. That's why I wanted to go last, because I try to support many of what you do so well, is advise your client and have that level of trust. And I think that's where the expert comes in now, to put that all in perspective and to work in scenarios. I do still think that there's so much more interesting product to position, and that there's a lot of work to be done to educate, and you do a great role at that case. So this notion of, okay, what are your goals and what are the options? And I think it's only getting richer, and chasing trends is one thing in investment. If you really have a diversified portfolio, as you said, it would be interesting to see how impactful alternatives are going to be, because they should be, but there's a long way to go. But we saw a lot of nervousness in April, and they're looking at you guys actually to sort of hold their hand and say, it's going to be fine. These are the 4 scenarios. I don't think you all have the tech yet to do so. Yep. But having said that, I think there's only one way up, I think, in the private markets, in my opinion. Huh?
It's an interesting point, Rob, that you're making, that you just put, as a fintech leader, and we keep hearing everything about AI, and many of us saw Elon Musk yesterday, which makes us feel like humans are going to be somewhat irrelevant quite soon with robots. But in times of trouble, at least in wealth management, humans play a very important role. And to automate everything, automate that telephone call that Andy had with his client to reassure, I'm not sure we can actually ever get there with AI.
It's not going to happen.
And, of course, AI is going to have a massive impact on elements of all of our businesses, but that human connection, Mina, you speaking to your client and just giving that kind of that reset moment, I think that should be a topic for another time, kind of the interplay between technology and human as we service our clients and scale. Let me jump into the main event topic here, because I think we really want to get to the bottom of exactly what's going on here. As an industry, what's happening is that technology broadly and innovation within alternative asset management is really pressing forward with making alternative investments accessible. And at the same time, investing just broadly is kind of blurring the line between traditional and alternative investing. So you have a few different factors here that are coming together. In the past month, we've seen Blackstone announce something with Vanguard and Wellington. I think there was two or three things with Barings and Invesco, KKR and Capital Group, Apollo and State Street, creating products that have both traditional and alternative investment elements in a single investment. Joan, since you're with us and you're on the forefront of that, what are you trying to get at exactly, and what's the strategy there?
Yeah. First, I'll say, I think who you partner with matters, because that's the material that's going to go into whatever the offering is. And so for us, it's been amazing working with Wellington and Vanguard, because like Blackstone, they are very investment performance centric. So we came together just to think about solutions, because increasingly, and everyone's hearing, individuals want more private investments in their portfolios. That's what their advisors are telling them, but they're not always the easiest to access. Technology, while it's better, really hasn't gotten to the point where you can invest in the same way that you can in stocks and bonds. And so if you can create something where there's value beyond just sticking things together, meaning you have someone really portfolio managing in very much the same way that you would have an institutional portfolio, like that's value add. So I don't think just putting these together in a passive manner and just letting them go is really going to be, the top way to do it, the best way to do it, best practice. But I think if you can really portfolio manage and you can combine active and passive, private and public, across asset classes with scale, like that's really, really compelling. And that's just one example. I think the path of travel is multi-asset, weaving things together, making them more accessible. And one thing that I think is interesting, that's maybe a little particular to us, but when we developed our funds in both private equity and infrastructure, we chose the structures that had the widest aperture for investments, not the widest aperture to raise money. And if you can take those QP products, and put them in a wrapper where they're much more accessible even to other investors, to me, that's like, wow. And I can't speak to any product. We haven't even filed anything yet, so more to come on that. But I think that some of these combinations will open new doors and kind of get to the belly of the beast, if you will, the many, many, many advisors who have yet to allocate at all to privates. And the initial feedback was overwhelmingly positive and, with quite a lot of inbound. So I think we think it has real promise.
And if you play that forward, though, do you foresee a moment where we're not even talking about the distinction between traditional and alternative? It's just a product that's trying to maximize return?
So again, I think when you're constructing a portfolio, so just think about institutional, there's the enhancing income, there's enhancing return, but there's also the diversification factor. And not to get too technical, but if you were to unconstrain liquidity and you were only thinking about return, that model would tell you to put 100% in private equity, for example. But that's probably not the right thing to do for any portfolio. So I think it's all of those measurements. And what I'm about to say might be a little provocative, but if you look at most of the CIO models out there in whether, it doesn't matter if it's an RIA or wire, wherever, what a lot of CIOs have done, because they can't factor in illiquidity, is they've artificially increased the volatility on the private side, makes them look much more volatile to squish down the allocations. And I just think that over time, those allocations are going to rise because, again, the model would suggest for maximal, return, yield, and diversification, it's really the only question you should be asking is how much illiquidity can you tolerate?
Right. Mina, your clients they tend to be a little bit more on the larger side. When you see firms creating kind of hybrid product, does that have appeal for your community of clients?
Absolutely. So as Matt mentioned, I oversee a business of ultra high net worth individuals, which we define as 25 million and over. And these individuals have been investing in alternatives for over 30 years with us. And to some of the reasons why is a little bit about what you spoke about earlier, in the sense of the investable universe is larger. So the amount of private companies outstanding over the last 25 years has increased 6 times. Public companies has decreased 1.5 times. So the investable universe is larger. The second thing is it takes the emotional side of investing and puts it to the side because of the mark to market. And then the third thing is because there's so much capital that is going into private investments, these companies can stay private longer and the value creation that takes place is more significant. So for this reason, we encourage our clients to have anywhere from 25 to 30% of their portfolios in alternatives. We recently actually took up our allocation to alternatives. That being said, we recommend that you do that over a 5 to 6 year time period. So it's really important not to time going long alternatives in any one vintage. And so you stretch that over an economic cycle and also multiple different sub-asset classes. Despite the fact that we've got a 25 to 30% allocation, our allocation numbers are below that right now. They're double digits, but they're below where our strategic asset allocation is. And that's because it is hard for investors to almost think, how much do I need to allocate to be able to get capital back? And you almost have to over allocate to be able to actually have the exposure that you want to have. And so I actually think the evergreen structures will make that easier, but that doesn't take away the perspective of doing this investing over time. The other thing I would point to is one of the benefits of evergreen structures is it takes the J curve out of investing. And so, for example, when private credit dislocated several years ago, clients had the opportunity to gain exposure to a fully funded portfolio right away at those yield levels. That was very attractive. There's also asset classes that I think are almost better suited for evergreen structures versus drawdown funds. Private credit or direct lending is an example of that for me because you think it's a 5-year term, the duration is 3 to 4 years, a third or a fourth of that portfolio is turning over every year, naturally providing the liquidity back to the extent that you have investors who want that liquidity. As well as providing yield. And even at these wealth levels, there are clients who still want some liquidity options, and so it does allow them to also have access to alternatives through them. So very relevant.
Well, Matt, you said something interesting in the beginning, and let's not forget that people want returns, but more importantly, most of the growth of the economy is in the private environment. And on the other hand, let's talk about the people that are trusted by the individual. They need to be educated. I think it's a longer process. We don't have the infrastructure. That's a different story. But I think at the end of the day, and you tell me, the advisors out there, how well are they aware of the alternative products that are out there, and what will it take? And to your point, it's quite technical, and we underestimate what it takes to really be able to democratize. And maybe we should talk about that, democratize alts in general, because that's where the return is going to lie.
I think we've moved on, though. I mean, for a while, it was this whole point around education, right? You'd go and, I have the vantage point of, like, I run an investment business, so I'm calling on wealth platforms, but I also have a wealth business as well. And, you heard a lot of hey, we have to educate our advisors, understand what this does. At the end of the day, though, more and more, as you make the rounds today, if you go around, they'll tell you, like, no, they're educated. You know what it is? This is pretty clunky to get this exposure on clients. They don't like filling out all the documents that they have to. They don't want to deal with how many K1s are kind of coming in and how do you streamline that. For sure, one thing again is understood by most of that this is the reason the models, like Mina just said, the models are that exposed to alternatives, is for the same reasons that institutional investors own alternatives, right? And the point that you made around your real question to individuals should be, how much liquidity, if you have the ability to take any illiquidity, you should. Then you step into, well, from a technology perspective, from an ease of use, that tends to usurp everything. I need this much alternatives, but wait a minute, I got to deal with all this? That's okay. I'll pass. So as technology is trying to catch up with kind of where this demand is, and you're seeing it in 3 different ways, right? The first one is the one where, in my firm at BNY is trying to do this on kind of the wealth servicing perspective, creating the technology that streamlines how you kind of have better, fewer documents, more ease of use. The second one is one where you're seeing used in the insurance industry with annuities. And I don't mean traditional retail annuities, but just lifetime income products, where now, typically, why are insurance companies buying this? That's where they're putting them in. Can you incorporate that in an outcome, like in a solution now that an individual can get? And the last one is the partnerships that you're seeing, like whether that's a Blackstone and a Vanguard or others. And I think that is really good, right? Because that now is testing the ultimate access out there, that it's not just a lot of folks can get access to an ETF that has both of these things. Then the question is, all right, what about the NAVs? Are we protecting the individual client? Well, I think some of these early announcements, as was said, look, there's no real product out there. At least my understanding of what will come out there, these things will have sleeves that are 3% or lower. All that, I think, is kind of testing the model. You'll see regulators come in, but there's a different variety of ways. So education is one piece, but I think largely where we're at now is how do you kind of have technology catch up to get it to that individual?
Yeah, I would even say a step further. That's the only thing we do. What you just described, we have invested now probably $12 billion in that, including in your company. And it's nowhere. I mean, 20 years ago in the capital markets, I see how sophisticated trading has become. There's nothing there. And because it started as a cottage industry. So there's a lot to do, in my opinion.
Yeah, I agree. I disagree that we don't need education, and I'm gonna call on Andy next to me, but because it's the 80-20 rule. So yes, you have a lot of advisors who've been using alternatives, and they started with the drawdowns. Now they're using the open-ended. There are so many advisors who have never touched it. And it's not because they don't know that it exists, but they don't know how it fits in a portfolio, where the allocations should come from. And I just know we're increasingly being asked to educate more and more advisors. And I want to do that because these do perform differently. And they shouldn't be viewed as ATM machines, daily liquidity. So to me, the education is essential so that everyone understands exactly how they work and how those fit in the portfolio. But I'd be curious on your journey. Obviously, you have 2-firm perspective, what you think.
No, thank you, Joan. I mean, I think the education challenge has changed a lot in the last 10 years. I mean, I think for advisors, 10 years ago, alternatives had a novelty aspect still. Clients were surprised that advisors could show them something that they may have seen in their role as on a board of a foundation or another institution. Today, awareness is widespread, but clients are also more educated, so they're asking a lot of questions about, hey, what's this exactly going to do for me? And I think the conversation that we were just having, where we go from, hey, it's kind of cool having privates and public securities in the same portfolio, to, is this going to be easier? Is it going to be better in terms of performance? And by the way, when we talk about performance, are we talking about after fee, after tax performance, or are we talking about gross performance? And I think clients are also, they understand today, hey, one of the big questions is, when the world goes upside down, what's going to happen here? And can you model it and show it to me, as Rob said? And I think we all know managing a single product that has public and privates, in a crisis, you can end up with a gate and having people redeeming with in-kind distributions. That does not feel good. You take it from just a product to a portfolio, and then you're thinking about leveraging the product, leverage that the client has in their overall investment portfolio, and then leverage they're carrying in their life. And you really need to be able to talk about it in all three of those ways if you're going to assure someone. And now, I'm hyper bullish on where we're going because we're handing more tools to advisors to build durable portfolios for clients. But this education challenge is going to be massive, and we should not underestimate it.
Yeah, Andy, I can remember a time when, and I don't want to date some of us on the panel, but I remember buying a mutual fund with a subscription document, right? Okay, now we buy a mutual fund instantly with the push of a button. It's not too far away until every alternative is being purchased that way. There's just no way the inefficiency in the system is going to happen or not get wrung out. So let's just say that that's going to happen. 1 year or 10, we don't know. And it seems like we're fairly unanimous now that it is a good thing to have some...
I mean, I'm going to disagree, though, because when you push that second button on the privates, you may have just messed up your tax reporting. Maybe. We don't know exactly, but there's true. This is a different beast.
Putting that piece aside, and we're going to go right back there in a second. But if we believe alts are going to be good for the end investor, good for the advisor to be able to have more tools in the toolkit, and that's a positive. We believe it's going to just get easier, whether it's product construction, like Blackstone is leading the way, or the use of models or solution-based allocation, as Mina and you were just mentioning. The train has left the station. So the title of this panel is The Convergence of Alternatives and Traditional and the Impact on Wealth Management. So what is that impact? Is there a negative side to that impact?
You talked about liquidity.
Mina?
Well, I mean, I think the convergence, by the way, it's happening.
It is happening.
We know that.
Yep.
Maybe the panel's best, how do we make this convergence a good thing? And then in the eyes of clients, the only thing that's a good thing is a higher probability that we're going to achieve the goals that we care about, which means returns.
Correct.
And not putting ourselves in a position where we're going to be surprised to the downside along the way. And there, I think, jury's out. There's a lot of evidence that should say we should be able to do it, but I don't think we really have the ability today to explain it perfectly to clients, to model it perfectly. And so this is, we're still in the early innings.
Yeah. So why do we call them alts, by the way?
Yeah, go ahead, sorry.
Why do we call them alts,
Well, that we're going to get there. Are the terms just going to go away and we're in the investment business? But what could go wrong if we fully democratize alts to the nth degree?
I think that manager selection is critical. And I think if you get overloaded with a lot of managers out there, and whether it's advisors or whether it's point and click, and I was recently with a technology company, seed company, that is literally top tier managers and many non-top tier managers where they're just letting anybody eventually subscribe to them. So I agree with you, I think that is coming. But that, to me, also comes with a lot of risk of actually the diligence of the managers, the dispersion between a first quartile manager and a fourth quartile manager is substantial. And so that would be one. The other thing is, really truly understand what the liquidity position is. And I actually try not to say semi-liquid and say evergreen. Not that that's that much better, but I do think it's a little bit from a mentality perspective. And where I would love to see the industry go is actually more where you've got duration matching. And so more in 401k offerings such that, and the clients aren't necessarily looking for the liquidity as much there. And that's where you can get a little bit more of that alpha generation from that vantage point. Yeah. So there's a couple different things.
And I think another thing that can go wrong is, I think it's returns. Because I think the clunkiness, the evolution of just about every asset class, you're going to go through some of these issues. I mean, real estate, something just individuals own, institutions own today. Most people can go to their broker and get real estate exposure, yet what you'll see is different correlation benefits between public and private, right? Again, if you think about portfolio construction, I think Joan mentioned you could look at an efficiency in Frontier. Sharp ratios will take you to say put 100% here or there. Now, the more liquid that access to that asset class gets, what you start seeing is the correlations change, the return profiles change. Again, private credit is talked a lot about today. What happens if all of a sudden you can put it in every retirement portfolio? Should you expect returns to? I think you should expect returns to start normalizing along more liquid portfolios. So again, I think part of this is as you normalize this, then you got to ask yourself the question: are you going to be able to offer that same excess return that you were able to offer in these vehicles?
I want to hit the regulatory environment and defined contribution in a second, but one question, Rob or Andy or anyone. We've seen BlackRock buy HPS. We've seen Franklin Templeton acquire many alts firms. These pure play alts players, are they moments away from just being in the traditional asset management business and vice versa? Will every major firm that has market share just frankly be in both industries?
I'm probably more bullish. I'm more bullish on alliances than acquisitions, because the topics of culture, talent, compensation, just issues around how do you manage the firms, I think get very challenging when you try to, now if you're BlackRock, you can pull it off, and they have and they will. But I think broadly across the industry, we're probably going to see more of these, really innovative alliances where distribution reach and liquid public market products can be brought together with the specialized expertise of an alternative manager.
And what is a good investor? It's actually judgment. So you should argue that there's a reason why these expensive 2 and 20 models existed, because there were some very smart people working on certain theses and ended up making investments and making the company better. And in the public market, it's proven to be very hard. So I would argue that the alliances are great, and we have to try to democratize, because some of these investors, to your point, certainly the top tier, are doing an amazing job. And we don't have to, I think this is not about asset management and wealth management, but coupling in where do we put money to work to grow an economy, and as a result, have better companies, and can somebody with a smaller budget have access to that? The biggest risk, in my opinion, is this whole what happens when it goes all the way around, and then the whole notion of potentially not having liquidity. But you can't have it both ways. On the one hand, the full liquidity will not get the kind of returns that some very smart person focuses on certain stop areas. Or will that all normalize? That's what you said. Is that what's going to happen? Or is special talent for something special, a special GP, something quite powerful? And I would argue there are some examples at this table, specifically Blackstone. They have proven over and over again that their specialization, their focus, their pivot, and so on is so powerful. Why would not other people have access to that? Because that is going to drive returns, in my opinion.
Yeah, I also think nothing can grow to infinity. We know that. But there is a real difference in returns with scale on the private side versus public. So public, scale is your enemy. Private, it's the only way to actually have differentiated investments and returns. And if you think about the open-ended funds in certain sectors, and I'll just use, actually it's true in real estate, it's true in infrastructure. So if you just think about infrastructure as an asset class, right, a lot of the incremental return is in your follow-on investments and like building massive platforms, differentiated platforms. You can only do that with tens of billions of dollars. And frankly, even in private credit, it is such a massive asset class. And if your fund is small, you're either going to just tag on to other people's deals, or you're doing small, mid-sized companies, which are smaller, so which are riskier. So I do think you're going to see, and you made the point about differentiated returns, top and bottom, increasingly differentiated returns. We're going to go through cycles. But I think we're nowhere close to the point where scale is yet going to squish down returns. And I think all the way back when we went public, so it was 2007, we were managing $88 billion, and the most frequent asked question was, how are you possibly going to grow?
Right.
90% of all real estate's private. 90% of all companies are private. It's like 10 times the size of public markets. So we're just nowhere close to any kind of saturation. I can't think of really any firms where the allocations to private markets are anywhere close to where they're targeting. So I agree at some point, but I think we are nowhere near that point.
You know what surprises me? I read a recent report, I think it was by the IPA, put it out. We're all talking about, liquidity and making sure that we have a lot of transparency if advisors and clients are buying illiquid investments. But you look at the defined contribution landscape, by definition, long term. And you see the complete lack of alternative investments really anywhere, target date funds, whatever it might be. I don't know, Jose, do you have a thought on that? And we do have a more friendly SEC that is looking at exactly on how to, break that down.
One, I would say, if you think about a segment that kind of needs diversification in these outcomes, and for sure the retirement segment is one that's massively underallocated any of this. Then at the same time, there are DCIO channels today that can invest in a crypto.
Right.
And actually could put the majority of their 401k in a crypto asset. Now, I have your own views on crypto. I just think that may not be the most aligned, vehicle for a retirement kind of chassis. So the short of it is, one, it's like, look, you need more innovation to bring more diversification and income solutions to that channel. And you're seeing that happen today. Like I mentioned, one of the biggest things with Secure Income Act is the fact that you're being able to tie in guaranteed income, versions into this, which by the way are mostly backed by private equity, private asset classes. And then from a regulatory perspective, I think this is the other nuance, because I agree with Joan. Look, I think the whole reason this is a huge opportunity, you're nowhere close to the bringing returns down. Yet, look, eventually it happens. It happens to 2 and 20 model, I'm sure there's some that still exist. Doesn't exist in its own right. I mean, some of these things do start kind of getting truncated. But as you get into when you get into that retirement channel, when you're buying insurance companies, you're now going to introduce regulation, right? The idea behind this before was, hey, this is being sold or bought or implemented by sophisticated investors, wealthy investors, institutions. So you should not burden it with tremendous, regulation. When it is the hands, of the person working the cafeteria line, again, just across the board, you're going to introduce regulation. That's just the way our markets work. And that's not always a bad thing, because it kind of helps provide more transparency and provides hopefully more access. But it will be more disruptive as to, ultimately where does that take it for the firms that have not been used to operating with that lens.
And I'll just pile on that. We're also, you asked a question in the context of the SEC. We're actually not talking about the SEC. This is the Department of Labor. So this is fiduciary with a capital
DOL,
F.
yep.
And there's a lot of topics here around conflicts. And, this is much more than best interest in terms of, the standard with which, we need to operate. And so, and I think we can have political disagreements about it, but this, as Jose said, the idea that the bar should be high when you think about how broad-based our core retirement programs are.
Yeah, if the DOL can provide safe harbor to the plan administrators, then, but we're living in a world now where they're getting sued for long-only funds, plus or minus a basis point, and thinking about even taking on the alts adventure is just not possible. But I mentioned the SEC only because they are also helping, deregulate. As many of you know, that they're at the same time looking at even the QP standard, the $5 million net worth for more traditional alternatives. Now we're really blending terms here, but also bringing that down to a credit level, which either $1 million net worth or $200,000 income. Rob, I think I might have
No.
cut you off on.
No, not at all. I mean, the question is, and again, it's more, you have an economy that there's fuel of innovation, and it's happening in private markets. So you're just excluding, what did you say, 80% of where the growth is going to come from. And you become an investor, and what do? You invest in economies, you invest in companies that grow economies. So how do you not have exposure to that? It's all about portfolio construction and judgment, in my opinion. But it's not going to be easy. But you as wealth manager have a very important role to play. At the same time, the private markets have to continue to be innovative. And the personalization, in my opinion, of understanding what product matches the need, the infrastructure doesn't exist. I agree completely with you there. It doesn't. It's a cottage industry. Unlike the core banking business or the MasterCard, Visa, where a payment is quite seamless, it's not here. It's hard. And a lot of people are not educated.
But and again, the point, I mean, like, the key point here is that we have to get there, right? Because ultimately, to your point, you know, if you believe correlations are important, if you believe having certain income or solutions are out there, this is now a massive part of our capital markets. You're seeing institutional investors invest in it. So I think this is coming. The question is what happens between now and then, and what are some of the disruptions? I often say some of these things are headwinds. I view as tailwinds because they're the things that kind of need to happen to kind of break the dam and kind of drive more transparency and access.
I mean, there is another way to solve the problem, to be provocative, which is make it a little more appealing to be a public company. And
less reporting then. Okay, less reporting.
I mean, you know, a little bit of that, you know, in the regulatory agenda, I think would be really positive.
Or the other way around, where you actually, I hate to say it, where you create a set of standards where there is a higher form of transparency in the private markets. And I think we try to, you talk about it a lot.
Well, it's interesting. We're converging on
it. And as a result, if you agree on a set of protocols and the standards, and that's where it becomes more difficult, because in which private environment do you want, because how far do you go? And you hear I was part of a public firm for a very long time, these quarterly analyst meetings are not easy, and you're in the boardroom and you say, you know what, this is a 3-year payback, we're not doing it, thank you very much. And so this rat race, and somebody was telling me in Europe, we were in a panel, he says, let's report once every half a year. And so would you like that?
but by the way, that convergence is like, I sit on the board of Moody's, and I mean, this is public information, and you know, they're looking at this growth and quickly moving into realizing, you know, it's a matter of time before you're going to need more ratings applied to these things. Not that some of them are rated, but not by the Moody's of the world, S&Ps, and that's showing up in the mix. Why? Because you start putting this stuff in DCIO platforms and stuff, like, you're going to need more transparency. I could tell you that Moody, and again, it's public information, they've met with the big kind of private credit shops around this, and that's coming as well.
Well, of course. I mean, you know, we all got together and created something called Daphne, which is a protocol to agree on a standard reporting. And then Bloomberg has just said, okay, we're using that as our standard. So it's coming, but somebody will have to give them the data, and there's one way to have an existing agreement to then see, okay, which rating do you give it? It's not that simple, of course, because what are the comparables and those kind of things? There's not one way of doing it. That's the beauty about the public market. It's very transparent.
I thought we were going to get away with the panel at the Milken without an AI blockchain question, but it came in, so I guess we're going to have to hit it. We just hit 4 or 5 different elements on alts going more mainstream, whether it's product structuring or technology or just the making it easy category. Where does blockchain or AI fit into your precise business model at Blackstone, at Citi, at BNY, at Motive, at Goldman? How are you thinking about that, and does it play a role in this conversation?
I'm happy to start. So we are thinking about AI a lot, and we are starting to implement it quite extensively through the firm. I would say predominantly at this juncture, it is to enhance the client experience, it's to increase our operational efficiency, make our engineers stronger. And within wealth management, it's really about increasing the team's productivity as well as, again, the client experience. And so I think there's just going to be a tremendous amount of opportunity.
Is there an example that you can give us?
You know, I'll give you, I can give you 2 wide-ranging ones. One is, you know, we run a global business, and we have people in China who like to engage in their native tongue, Mandarin, and most of our content is put out in English. Okay, now we have Wealth Translate, And so everything is translated from, and so instead of having an analyst sit there and try to translate all the documents, which is going on, okay, now it's like that across all languages across our business. Another one, for example, is because we have been in alternatives for quite some time, and we work with individuals on this stage in terms of offering their products to our clients. Our clients have a number of different investments in their portfolios. Well, the ability for an advisor to be able to stay up on that, but even the advisor, but you actually want to get that in the hands of the client also. When are you making an investment? When are you monetizing something? And that is, just to be able to look through the quarterly reports and in a very concise way, give that to the advisor and to the client allows you to actually have more investments versus less. Yep. And then, I do think, and I think somebody hit on it, it will take time for us to use AI or AGI to help us really with portfolio construction on the private side. And that is because the data is relatively unstructured right now, and it is not also verified. And so I do think from that vantage point, there's a much bigger public market opportunity than there is from a private side.
Agree. Yeah. Rob, just a quick question for you. We couldn't not talk about blockchain or tokenization 5 years ago, and then no one talked about it again, and now it's back. So what's going on?
Oh, what's going on? Lots is going on. But I think we completely underestimate. So to quote three totally different people, Eric Schmidt said, we're underhyping AI. Somebody else on the panel says it's going to take 20 years to even see any form of return on this. The bottom line is legacy is the issue, and the way we used to do stuff and still do stuff. And it's massively complex. Just to your point, a PPM, just onboarding a client, moving something from somewhere in the custody where it's a huge amount of legacy. The average, I would say, average age of that tech is in the 80s. And when somebody came up with the blockchain idea, it's a phenomenal idea, single truth, where people can connect to, and we know it's much more easier to reconcile and so on. But we all have to be in it together. So I think there's a contrast between the legacy, the future state. I think it's underhyped, I agree with Eric, but it's probably going to take 15, 20 years. But it's an unbelievable technology, but we all have roles to play. And I like many of you on the panel have a combination of high goals and then do incremental steps. But the efficiency, I think our industry, maybe to be controversial, to get it a bit juicy, I think we can, this business is going to have 15% of its workforce in what it does today, 15. So 85% of it, and they will probably do something else. But once that technology, it's going to be very different, in my humble opinion.
Yeah, and again, you make a good point, because I think the human emotion side of it is kind of, you can't discount that. Though, look, ultimately, you'll get over that. I think, to me, very few people would deny now AI is going to be, and especially like what I've seen is just how much it accelerates. I mean, literally, some things from like January to March, you're seeing it do so much more within our own business. But I'll tell you, it's going to lead to a lot more consolidation and M&A in the industry, because I've kind of seen it being at different shops. I mean, part of a large firm at BNY. They launched one of the first formal partnerships with OpenAI. And from a tech perspective, they're spending billions of dollars. I have access to that, just kind of being part of that broader like tech stack. But like, think about all the different managers out there. How many folks are really going to be able to spend that kind of money? Yeah. Or focus on AI, which, by the way, is going to it's going to be a difference maker. Like you're going to have to be able to invest in this technology to move forward. And so I just think that's the other reason you're going to see continued consolidation in this space, because scale is going to matter to be able to invest in these things.
I'm like highly optimistic on the thing, honestly, that we said would be the hardest, which is, today we've got a investment lab that can roll out a half a dozen quants to tear apart a billionaire's portfolio and help size alternative private market positions with an eye to liquidity and all of the characteristics. I think in 3 years, that's going to be, AI is going to be able to deliver that to every client. I think, on the other hand, having a market infrastructure where Rob went is going to take a lot longer. And there's topics that we haven't touched on yet, like secondary trading of LP interest, for example. For something really to scale, you got to be able to see the way out on the back of your investment. And boy, that's really much more idiosyncratic, not just from a technology standpoint, but every legal agreement is different as well. So I think that's probably more on the 10 to 20 year, time horizon.
I'm super optimistic. The way we are thinking about it at the firm now, we have a very large team of data scientists. We just hired the head of McKinsey's AI practice to run our portfolio ops team, so we're going to be deploying everywhere. And if you think about investing as pattern recognition, and I think about our private equity business, the practice is when investment memos go out, the questions that are asked are circulated to the entire investment committee. Everyone sees them. So to be able to take all of those questions and all of those answers from the number of companies that we've looked at and put that into AI and distill patterns like this, you can load up companies, financial statements, what should we be looking at, what are questions, et cetera. Now you still need judgment. I believe judgment's important, whether it's for investment advice or it's for investing. But wow, you will be able to look at a whole lot more than you can today. And I agree initially, it will be, probably, we think it's high value for us, but yes, lower value, whether it's legal agreements and all of those things that are nuisances that you'll probably be able to do more efficiency. But I actually think it's like, if you think about the origins of every transformative technology going, whether it was electricity and the first use case is a light bulb, we've kind of moved well beyond that. Or even e-commerce initially, where it was like buying Beanie Babies. And, it took companies, a lot of companies, unfortunately, too long to figure out that, it's going like this, but whoosh, now it's going like this. Yeah. I think with AI, it's going to be much, much faster. And I don't believe that the hyperscalers would be investing billions and billions of dollars. These are the leading technology firms if it weren't real and if it weren't transformative. So my expectations on what it ultimately will do is very high. And I just think we don't know what all of the use cases will be, but they're going to go so far beyond what we can use it for today.
I think we can all agree you ain't seen nothing yet, that's for sure. But it's going to take
I could
a while.
not agree more. All right, we're almost at time here. Just one final comment from each of you, and I can't thank you all enough for joining this panel. All the insights been great. Looking 5 years ahead, what's the one thing about wealth management that you think will look completely different as a result of the convergence between public and private? I won't go in order just in case you need more time to think. But you all have to go.
Yeah.
Joan?
There's no crystal ball. But the one thing I will say is it does take a village. And I look at everyone on this stage, and I think we will all be working together. Some of us already are, even more closely. And I think as private investments just become part of portfolios, they just become easier to invest in. It won't be that they're a sideshow. They'll be integrated on your statements. They'll be integrated in models, in SMAs, hopefully in defined contribution, just like they are in institutional pension funds and the like. Again, it's hard to prognosticate exact timing of things, but I just don't think. I'll say the following. It's my head of sales recently said, I was always so proud because advisors are constantly coming up to me saying, like, your people are amazing. I took so-and-so with me to meet my clients, and they were so effective. And he said, I was so proud, but now I realize, like, I think it would be better if they didn't need our people, to do that. And I do think as the education moves and all of that, again, these are just going to be not this exotic new thing, but just a very real way to enhance return, enhance your income, and diversify your portfolio.
I think if you believe, and I think there's a lot of reasons to believe, taxes are going up, and we know transparency is going up. 5 years from now, far more discussion of after-tax, after-fee returns around portfolios, and a lot less, hey, let's just talk about the gross and forget about what the client really is experiencing.
Yeah, and I think that I think you touched on this at the beginning, the term alts, and it keeps shifting. It used to be private equity on these things. I think ultimately this stuff will become just equities,
Just
fixed
investments.
income, and also be used for whatever the next thing is coming.
It'll just be liquid or not liquid or less liquid. Yep.
Better infrastructure, more transparency, democratization, and finally something that embraces the innovation, the technology that the promise holds, and that some of that will trickle down into our market.
I would say that the wealth demographics are going to shift a lot over the next 5 years. We're seeing it, pan out now, and it's only going to accelerate. I think that client base does like more alternatives. I do think they also very much value simplicity. And so to the technology points as well, those will be supercharged. And I also do think even looking at other asset classes like life insurance and things like that, and actually constructing a client's portfolio and construction inclusive of more investment opportunities beyond just public-private stocks and companies is something to consider.
Great. I'll tell you mine. I think we're going to have happier clients that can build wealth for a greater future. Thank you very much.
Thank you.
Thank you.